Hello, I'm Los Angeles City Controller Ron Galperin, and I'm so pleased to be part of the Los Angeles Public Library's continued work to promote financial literacy. All year long, the library, through its outstanding Department of Lifelong Learning, hosts life-changing programs that teach and support financial empowerment, immigrant integration and inclusion, and health and wellness. And the best part about it is that it's all free. As controller of our city, I make sure that public dollars are being put to good use, keeping our government honest, responsive, and accountable. Because people want to know and deserve to know that their government is doing its best to serve them. While it's important for the city to plan how we use our money wisely, I want you all to know that it's just as important for you to do the same. Because the city's financial health depends on the financial health of all Angelenos. The programs that the library is hosting this week and throughout the year are here to help everyone succeed and to make positive financial choices for our futures. I'm so grateful to all of our libraries and incredible staff, and VITA and its volunteers for all they do to ensure that you and your families have the tools and resources not only to prepare your taxes, but to help you be on the right financial track. Thank you.
Good evening. My name is Chris Grisham, and I'm a reference librarian in the Central Library Business and Economics Department of the Los Angeles Public Library. Today's program is titled Investments Workshop, Be a Smart Investor. This program is part of our Financial Literacy Week, and our presenter is the Financial Planning Association. Thank you for attending our program tonight. The Business and Economics Department provides programming throughout the year, and you can find our programs listed on the library's online calendar at www.lapl.org. The Business Department also maintains its own Facebook, Twitter, and Instagram, so you can follow us there as well. I invite you to send us your questions during the course of the program, and we will have a Q&A session after as time permits. With that said, let me introduce you to our guest presenter. His name is John Horn, CFP, Certified Financial Planner. He has his MBA from the University of Southern California, and also his JD from Loyola Law School. And with that said, I'd like to introduce you to John Horn.
Hi, everybody. Thank you for joining us tonight. And as Chris said, our topic tonight is investing basics and how to become a smart investor. So this is for educational purposes only, as you're aware. And this content has been gathered by those of us at the FPA. And so I'm happy to take you through the presentation. Fair amount of things to cover, so we won't dive too deep, but I'd be happy to answer any questions at the end of the session. And so we will make sure we leave time for that. The things we're going to cover tonight are how we're going to explore some basic investing and investment concepts, how that fits into the overall financial plan, introduce some general strategies, and of course, discuss ways to put these into action. So what we're not going to do is we're not going to give you any stock tips or help you become a top stock picker or provide any insider information. A, that's illegal, and B, we don't have it. And we're also not going to recommend a specific course of action. In fact, that's why it's so important to learn on your own, so you even know what questions to ask when it comes to putting your financial planning, your financial plan strategy together, because a little bit of information will go a long way, and then you can at least that will help guide you find to where the right information is, and then or the right individual that can help you put it all together into a comprehensive plan. And then we'll help. Then we will specifically provide a recommended course of action if one is required. So some of the key concepts. that we're going to talk about are, what are some of the things that the smart investor must know, and understand that this is different. And the pandemic, I think, is something that has been a pretty good example of how the economy is really, there's a difference between the wages that we bring and the income that we make, and then what we do with those wages, whether we use them to live or whether we use them to invest or various other things. And what we're talking about is now, uh, using a percentage of that income that we bring in and putting it to work for us. And the longer that we have in our investment horizon, the more that will grow and the more we can have it work for us. And the way that starts is with saving, right? You have to at first be able to start putting some, cash flow away, and you have to start somewhere, even if it's just a couple of dollars a month or a week or a paycheck, whatever you can afford. In essence, you're paying yourself because this isn't money that's going to bills or any other thing. So pay yourself first. And then we go down into investing. And then within investing, there's various other aspects of investing that we need to consider, such as risk and return, asset allocation, diversification, and asset location. And basically, that means, how dangerous is the investment? What are we going to buy? Um, are we gonna buy more than one type of thing or invest in one type of asset? And then where is that asset going to be held? And so as we go through tonight, we'll talk a little bit more about each one of those things. Saving is, of course, the most important aspect. It's that first step. You actually have to start putting money aside. And some people have access to savings plans at work, whether that's a 401k, a 403b, a 457, something that might be part of a plan, or they may be work for limited companies that actually provide retirement plans for their employees. But even those people who work for themselves or don't work in that traditional type of environment, they do have an opportunity to put money away in a tax favored type of account. And, and what our objectives are in our savings, as the bars show, is we want to make sure that we're earning regular interest in a savings account. And we're talking just about a saving now. We're not talking about an account where you can, where you're actually investing it specifically. So the first step, have a savings account. This provides cash. This is where your emergency account is going to be. You want to put it in something that's going to earn regular interest. You're going to have money available immediately when you need it. So you don't have to sell something or whatnot. And money in a savings account is generally very safe because they're insured by the government through the FDIC or the SIPC, depending on what type of account it is. So there's insurance on it. So even if there's a problem with the institution, the government will make good on the money you put in there. So that's absolutely the safest place to put it. When it comes to investing, though, we want to, as especially as interest rates are very low right now, and we're not going to get that type of growth with very low interest rates. And so this is where we, start talking about investing. Now, investing is different than saving in the sense that saving is actually the process of taking money out of your cash flow and putting it away. But then the difference between a savings account, which we just covered, and an investment account, well, here now we're buying assets for their potential to increase in value, to provide income, or both. And ideally, they're going to provide both, whether they increase in value now and provide income later, or both at the same time. Investing provides you a way to do that. Generally, investing, you're talking about a fluctuating rate of return as opposed to in a savings account where you know the rate of return that you're going to get when you make the deposit. And with investing, if something is invested, you must sell those assets if you need immediate cash. And so it may not be a good time to sell assets. If you think about people who retired in 2007 and started liquidating their assets, they were doing a lot better than people who are waiting until 2008. It's very difficult to time a market. And so it's always a good idea, especially if you know you're going to need money in advance, to start putting away money into savings and making it so it is more available on an immediate basis. And then, of course, understand that investing, there is a risk of loss. So, and we'll talk about that later in the program. But you want to be rewarded for the risk that you take. So when you're investing, you can invest very safely and not possibly have the potential for such great returns as if you took greater risk. So you want to be rewarded for that risk. So what are the reasons why we're going to have two different types of places to save and invest? So the money that we're going to save and we're going to keep in savings accounts and what we call liquid or cash equivalents, that's the money that we're going to use for vacations, for emergencies, and for short-term goals. So even if you're saving up to buy a car or even a major purchase, more likely you're going to keep that in an interest-bearing savings account where you're not at risk of it going down as opposed to going up. Investing, we generally want to have our money work for us, and so the longer that money has a chance to work for us, our investments, the greater that the potential is for growth. And so the type of things that we would open accounts for saving, naturally retirement, which are some of the accounts that I referred before. There's college accounts that you can save, or either within a savings account, an investment account, or specific accounts called 529s, which are accounts that are specific to college. And then for other long-term goals, whether that's supporting a family member, lots of other examples that you can imagine. But again, you're investing for the long term. You're generally saving, quote unquote, for the short term. So there's a difference between financial planners and investment advisors. Some of us do both, but the actual process is very different. When you're an investment advisor, those are when you're looking at specific investments that you're going to put your assets toward in the hopes of reaching a certain goal. But to make an investment without doing the planning seems premature. That's like, trying, knowing where, I want to get to this point, but not figuring out a way to get there. And so that's what financial planning does. And again, a little bit of knowledge, investment comes later, and the planning usually comes up front. And really, by definition, it's a comprehensive and systematic process for getting your financial house in order and helping you meet your financial goals. And there's various elements to financial planning that a lot of advisors and certified financial planners have been trained upon. And some of the areas of which financial planning is important, for example, insurance. Insurance is often used and is a key element to financial planning. And there's more to it than just life insurance. If you think about it, you have to insure your car. Some insurance is mandated by the government. So if you want to operate a car, you have to have insurance. Why? Because you don't want to have a mishap turn into a financial disaster. And so insurance is used that way in many other ways in the planning process, whether that's as part of the estate planning process or even, obviously in the event of emergencies and so on. Financial planning is understanding your employee benefits, what are available to you, what aren't available to you, and how you need to make that up. Investments, again, where you do have accounts where you're putting in money on a regular basis into a certain account, you're going to want it invested. And so that is part of the financial planning process. But a lot of that comes in again with discussion. Every individual has different feelings about investing and risk and comfort levels and so on. So that's all part of the planning process. Taxes, as you can imagine, are a very important part of the process. There's three ways to hold money, and some of it is taxable now in short-term accounts, so like savings accounts. If you earn money in a savings account, that's short-term, and you're going to be paying interest on that. And there's deferred accounts, so money that goes into your retirement accounts is deferred, and you're not taxed on that until you take it out, generally. And then, of course, there's money that you pay the taxes on early, and then you put it away, and you don't pay taxes on it later. That's a tough bucket to fill, but very important part of the tax planning process. A lot of that leads up to retirement, right? So when you get to retirement, presumably you'll be holding money in all three of those areas: short term, deferred, and then, of course, already taxed or non-taxable areas. And you'll draw on that as it makes sense in retirement. And of course, estate planning is a function of not only setting up your beneficiaries, but doing so in a tax efficient manner and making sure the right assets go to the right people. So you can imagine if you just got some money and decide you're going to open an account and start investing without considering all these areas, you will probably have a greater chance of success if you take a step back and do some planning before you get to investing. So, leading to the next slide, aside from the planning portion, there are also some basic steps that you should take before you invest. First is understanding, get a handle on your cash flow. How much can you set aside on a periodic basis, to support your investments and lead to your investments. Now, you can choose to do that if you get a bonus, for example, or an inheritance. Of course, you're going to get lump sums periodically, or hopefully, but generally, it's something that's going to have to come out of either your weekly or monthly cash flow, and you're going to have to make a point of setting it aside. That's why employer plans are so great, because if they take it out for you from your check before you actually take it home, it's kind of like you don't feel it as much. And that is generally the best way to save. One of the easiest ways to begin an investment account and keep it going is to automate it. Have the money taken out, even if it's just a few dollars every month, and you'll be surprised at how fast it builds up. Build a cash emergency fund. If you want to sleep better at night, it'd be nice knowing that if a sudden expense came up, you have the cash somewhere, preferably not under your mattress, to take care of that. And we've all had medical expenses or car repairs or something like that. You don't want to have to put that on a credit card or sell something. So emergency funds, or every financial planner will tell you that is really the first step in the process. Next is pay off an expensive credit card debt. Later on, we'll show you how the stock markets have performed over set periods, and generally, it's always going to be lower than what the interest rate is on your credit card. So if you're can earn 7%, but your credit card is charging you 18 or 20%, obviously you're better off. A better investment is to pay that off first. Buy the right kinds of insurance. Again, this is where talking with a professional or an insurance professional to help you determine whether you need the right life insurance, for example, between a term or a whole life policy, or long-term care insurance. And there's very many flavors, even homeowners insurance, that a financial professional can help you make the right choices. And of course, write a will. You don't want what a will does is it determines how your assets will be passed on to your beneficiaries. I've heard many times, "Oh, I don't have that much." Well, whatever you have, this is your opportunity to designate how it passes, because you don't want the government to do it for you. And that's what will happen. So for the benefit of your beneficiaries, make sure you write a will before you begin the investment process. Then it's time to start investing. So as I mentioned, the easiest way is to participate in your employer plan if you're eligible. It's automated. It's generally low cost. You'll have some simple options that you can choose, and you'll be surprised at how fast it adds up. If you don't have access to an employer plan, or even if you do, it's also a good idea to open up an IRA, an individual retirement plan. You get many, almost all of the tax benefits that you get in an employer plan. You generally have more places to invest than you can, and the rules are slightly different, but the objective is the same: is to save money in a tax-deferred way until you get to retirement and you start taking it out. College savings account, again, you can set one of those up. A great time is when the kids are born and you put a few bucks away, and then there's something called the rule of 72. And what that means is that roughly 7.2% interest, your money will double every 10 years. So if you put away, a few $100s, every month, you'd be surprised at how much money is available for college. That being said, there's lots of places that will help you pay for college, but no one will help you pay for your retirement. So pay yourself first. Don't forget that. Put your money away in your retirement before you start putting money away for college. And then finally, the last step would be to invest in a taxable account. Again, this provides you more flexibility and so on. So once you reach the maximum contributions in your retirement accounts, now you're adding to that short-term bucket and invest in a taxable account. Part of planning is having an investment plan. And so your financial planner will ask you questions and help you determine what your goals are. And the more specific, the better, and a time horizon. And the more specific, the better. How long? What is your investment horizon? Is it from now until retirement? When do you see yourself retiring? Are there milestones in between? Those type of things, and we can plan for that. So when are the kids anticipated to go to college? Those type. When are certain things going to be paid off? Would you like to buy a house? You need to balance your risk and return. As I mentioned, you want to be paid for the return, for the risk that you take. So the more risk you take, the more return you expect. It's going to come a point where it becomes too risky, where it's foolhardish or full foolish, sorry, or you aren't getting the return that you require, and so you're going to dial that back. You want to have an investment strategy, and by that has to do with how active are you going to be in the investment process? Are you going to be buying and selling? Do you want to set it and forget it? Are you going to have an advisor, and so on? From within that, you select your investments, you make your purchases. Sometimes, generally, you're going to do that over time and not all at once. And then over the course of time, you're going to monitor and update your portfolio. So risk and return. So risk is the possibility you could lose some or all of the money that you invest. The more risk you take, the greater the potential for larger return or greater loss. So just think about a pendulum, right? So it's going to swing one way or another, and the arm of that pendulum, the more risk you take, the greater that arm will swing back and forth. The return is what you get back as a percentage of the amount that you invest. So conversely, if you want to limit how far that arm can swing, you're limiting your return, and thus, but you're also limiting your loss. So on a savings account, that arm doesn't swing at all, right? On a treasury bond or a government-sponsored bond, that arm is going to swing very little. It could still go down, and it's more likely going to go up, but not nearly as much as were you to invest in the stock market in general, buying the entire market. And then at the very end of the spectrum, you're talking about alternative investments and options and SPACs and all kinds of other things that are far more risky. So the first step that you're going to take and how to understand what we call your risk tolerance is you're going to ask yourself certain questions. Are you willing to lose some principal in pursuit of higher returns? Do concerns about your current investments keep you awake at night? Do you make changes to your investment account every time the market drops? Do you monitor your account frequently? That just these simple questions, you're not even putting a number on it or quantifying it, will give you an indication of how you feel emotionally about the risk that you're taking. Once you make the investment, the emotion is how you're internalizing what's going on with that investment, but it doesn't affect the investment itself. Someone who buys a stock the stock is going to do what the stock is going to do, and so it's how you feel about that stock and what it's doing. So understanding that risk tolerance will help keep you able to sleep at night, comfortable with the return that you're getting, and if you're not getting what you expect, to maybe be introspective about maybe taking a little bit more risk. Be realistic. Key. A lot of the times where I know that I earn my fees on behalf of my clients is by being realistic and trying to say that trees don't grow to the sky, and conversely invest in the market when the market goes down. That's a buying opportunity. So recognize that investment markets gain and lose value in recurring cycles. Remember that if you use only insured accounts, your return will be limited. So those are savings accounts mostly. Evaluate what you can reasonably expect to earn from your various types of investments. So as I mentioned, that if you need, you have a 10-year investing horizon and you have $10,000 now and you think you'll need $20,000 in 10 years, how are you going to get that from 10 to 20,000? Well, as I mentioned, the rule of 72, it'll double that. So if you're not putting any of your any additional deposits into that account, and and you invest it 100% in the stock market, chances are, under normal returns, you'll have $20,000 as in 10 years. And of course, we adjust for that along the way. That's where the monitor part comes in. Conversely, if you invested in treasuries or something like that are paying 2%, in 10 years, you're not going to get there. So you have to be realistic, A, on what you're going to be able to accomplish, as well as B, on how you're going to get there. And of course, working or figuring out, there's lots of calculators that'll help you figure out what types of returns and just crunch the numbers for you. This gives you an example of the difference between what I was talking about in the various investments. So if you look at inflation that had run at 2.9%, which is obviously what the deterioration of your money, and that's the gray bar down there. And then just above it would be the 3.3% average return on treasury bills over this period. You can see that you would have $22 if you invested. Now, obviously, this is a very long period, 85 years. 95 years or so. You would have only made $6 in net gains over all that time. Yet conversely, small stocks, which were the riskiest, and you can see they had the biggest up and down, and they're the top bar. That dollar would have grown to $39,000. So over 94 years, small caps, more risk, more return, but understand that it smooths out over time, and that's the general direction it takes. But you can point to all these dips down and see where it's done less. So you can also see, and an advisor might talk to you about mixing with. There's a common thing called the 60-40 portfolio, which is 60% stocks and 40% bonds. And you can see if you average that out over those two returns of stocks and bonds, you would get roughly your 7.2% return with less risk and be able to double your money in 10 years. So when I talked about that return, you can see over every 10-year period, the stocks have gone up and down. Generally, they go up more often than down, but we had the lost decade 20 years ago. Conversely, we almost made most of it all up over the last decade. But if you average that out together, again, that's going to run roughly around 8% over any 30-year period. So what things happened in the past? The market is cyclical. Obviously, within these 10-year periods, there were good up years and down years. One of the nice things is there are more up years than down years. But conversely, it's math. So if a stock goes down 10%, you need 11% to get back to where you were. If the stock goes down 50%, you need 100% to get back to where you were. So the drops are going to be more painful statistically than the gains, but the market goes up more often than not. So you can kind of see on this how mixing up your portfolio will here. This is a 50-50 portfolio with a little bit less risk and so on. And what's nice to see is where these gray bars are in a 50-50 portfolio. Generally, and this is for a 70-year period, you're going to do a little bit better by mixing riskier assets and less risky assets. So when we're talking about asset allocation, how does that work? Well, it's an investment strategy that can help control risk without reducing the potential of return. And so what we do is the idea is that you invest in multiple asset classes at the same time, such as stocks, bonds, and cash, and you divide that on a percentage basis. And so again, the pendulum will swing more on the stocks than it will on the bonds, and virtually not on the cash. And you put it all together, that's going to overall be less risky than putting all your eggs in one basket or not taking enough risk to get to where you want to go. A common allocation, particularly for younger people, would be a 65-25-10 split, where you're in stocks and stock funds, bonds and bond funds at 25%, and a 10% cash allocation. So as you can see, you allocate by your time horizon and your risk tolerance. So younger investors can typically take more investment risk and allocate to more in stocks and bond funds. Older investors, they typically want to take less risk. And as I gave in the earlier example with the 2007-2008 scenario, one of the things that you want to do is as you get closer to retirement, particularly within the last 3 years, you want to programmatically convert your assets into cash. There's something called sequence of returns risk, and you don't want to go into retirement and on a down year because you don't have the time to make that up. So it's wiser to start that a little earlier. Of course, there's always exceptions to the rule. For those of you who are in retirement plans, and you may have seen in your plan, you'll have what's called the target date fund. And target date funds do exactly this. What they do is they anticipate how many years you have till retirement, usually in a 5-year block. And so there's a 2025 fund, a 2030 fund, and so on. And as you get closer to retirement, they invest more in bonds and less in stocks. What that does is that reduces the volatility of your portfolio and presumably reduces risk. Diversification. The old expression, all your eggs in one basket. There's a couple of different ways that you can diversify. One is you spread your principal within each asset class. So if you're buying bonds, you buy long and short-term bonds. If you're buying stocks, you buy big stocks and small company stocks, or international emerging market stocks, knowing that not all of these assets are going to be perfectly correlated. By that, I mean they're not going to move in exactly the same amount in exactly the same direction. Ideally, you want to find assets or investments that aren't correlated completely. So if the stock market's going down, but real estate's going up, that's a good thing, right? And that reduces your risk. Consider a combination of individual securities, mutual funds, and exchange-traded funds. An exchange-traded fund is like a mutual fund, except it's based on an index or a theme, a sector theme. Generally, a little less expensive, but both mutual funds and exchange-traded funds are baskets of stocks that you can buy rather than, if you like Apple or you like Amazon or something like that, you can buy those stocks, or you can buy a fund that has all those stocks in them. And then, of course, weigh each new investment for the diversification that it adds. One of the popular things right now in the market is electric vehicles. Okay, well, they for a while there last year, all the electric vehicles were very popular. None of them had come out yet, and electric vehicles are still less than 2% of the cars sold. So tremendous growth. Not everyone's going to make it, and buying 2 or 3 of those, you might want to diversify. I don't think those really add to the diversification of your portfolio, or that third one does. So then it comes down to time to choose investments. And so we want to look for investments that have the potential to deliver average annual return that you seek. Right? Again, this has to deal with the risk and the return. Past performance isn't necessarily a determinant of the future. Stocks go up and down. If you can think about Tesla is always a great example of where that's gone. Then you can also think about another company, Ford, or even GM. All these companies are much larger, yet their stocks are much lower. So you have to kind of look. Now, there's a lot of risk in buying Tesla, and those people were rewarded. People who bought it late last year are still not being rewarded. So you want to work with your financial professional to help you to add to the research that you do. We often advise people to invest in areas they know. It's a long-term investing tenet. If you work in a warehouse and you see the UPS and FedEx trucks coming and going, and you see your volumes rising, you know that their profits are going to go up. If you work in a given industry and business is good or bad, or there's someone that I have a client that was a realtor, and she thought, wow, this DocuSign is made my work much easier, and I think everybody's going to love it. And sure enough, that they have, and now it's become an integral part of the business. So if you can, when you do your research, good place to start is in areas that you know. And then choose among suitable investments that fit into your asset allocation and diversification plan. So, if you had committed to buy a certain amount of bonds, then make sure you meet that commitment and then rebalance periodically. Investment mistakes to avoid. Don't put all your eggs in one basket, or concentrate on 1 and 2 investments. Don't put money into investments you don't understand. Okay. And if the person, even if it's your financial professional, if they can't understand why they're telling you to invest in that investment, you probably don't want to do it. If you work for a given company, oftentimes you're given company stock and so on. Well, if you know it's a good company and you believe in that company, that's great. but there's other good companies too. And again, you're by putting too many eggs in that basket, you're limiting your diversification. And don't chase hot performance. Oftentimes, what you see in the news. I mean, lately, whether you were an investor or not, you've heard about GameStop and what that went on. Um, not everybody made money in GameStop and or in AMC or any of the other Reddit trades. Uh, so generally, you're better off investing in stable companies, investing for the long term, in things you believe in, areas that you believe in, and going from there. Other approaches that work: start investing early. Again, it's the earlier you get in, the more time you have for that doubling. Right? So if you have a 40-year investment horizon and you invest and it doubles every 10 years, that 40 years grows to 20 in your 30s, and 40 in your 40s, and 80 in your 50s, and 160 in your 60s when you need it. Just $10,000. Right? And that's if you never put another penny away. But if you wait until your 30s, you'll be putting money away every year, and then, even then, you miss that doubling from 80 to 160. So invest regularly, try to automate it. What dollar cost averaging means is when you put money in, you don't make an investment all at once. You can't really tell when the stock's going to go up and down, and stocks even go up and down during the course of the day. So if you are going to make an investment, particularly when you're starting out, maybe do that in 2 or 3 chunks. And that's called dollar cost averaging. And over time, it's shown to get you a better price on the way in and get you a better price on the way out. Do direct deposits from your paycheck. Again, this is investing automatically, and stay in the market. Again, understand, you saw those charts. At the end of the day, they still go up. There's going to be periods when they go down, and unless you absolutely have to get out, you're better off staying in and instead of trying to time the market. So this goes to show you that $10,000 average with an annual return of 7%. You put it away in 10 years, it virtually doubles. In 20 years, you get that jump, and then 30 years later, you've got 100 grand, and you're definitely beating inflation, which as you saw is run at roughly under 3%, and lately, last 20 years, it's been under 2%. Oh, let me go back. Manage your investments. Investment expenses. Boy, that's a big one. If you're, you don't realize that when a lot of people don't pay attention to that, fees and expenses. So if you have an advisor that charges X% and another advisor that charges less, that money is coming out of your return. So pay attention to that, and pay attention to the expenses within the investment themselves. I mentioned the difference between mutual funds and ETFs. Understand that one is more expensive than the other, and so you want to get more return for that additional expense. Be aware of taxes, but don't necessarily let them dictate your investment strategy. Taxes has to do with timing of short-term gains and long-term gains, and then the type of accounts that you have that you put your money in. But once your money is in, for example, into a retirement account, you don't need to worry that much about taxes until you start taking it out. You need to monitor your investment strategy to stay on target. So you don't have to know all the ins and outs of finance to keep an eye on your finances. And then rebalance your portfolio as needed to keep it aligned with your intended asset allocation. So again, if you decided that you want a 65, 25, 10 portfolio, and your stocks ran up and your bonds have come down a little bit and you spent some cash, so now you're at 75, 20, and 5, well, you're going to need to rebalance your portfolio to get it back, sell some stocks, buy some bonds, and save some cash, and get it back to that 65, 25, 10 portfolio. And your plans evolve. Your investment goals change, right? The kids get out of college, after you bought your first house, all these, you get closer to retirement, your goals change, and so your attitude towards risk and return should change along with it. Your financial situation changes. The economic situation changes. All right, think about what the pandemic did to how you thought about money, how you thought about your cash flow. Each one of these things will make you a more experienced investor. It's interesting. A lot of the talking heads that you see on TV are talking about how different generations have, the people that lived through the generation. Your grandparents thought different about money than people that lived during the boom times, and so on and so forth. So you become an experienced investor as you get through one of these. Looking forward, investing is a voyage of discovery. Um, you're not going to be right all the time. You're not going to be wrong all the time. Individual mistakes are not fatal. At the end of the day, it's only money. Uh, it's easy to get caught up in it, especially when things are going in one direction or another. So it's important to learn from your mistakes. Learn from your experiences is essential, but also pay attention to your cues. Uh, if something happens and you look at how that make you feel. If your portfolio went down a lot and it didn't bother you too much, well, that may indicate that you have a higher risk tolerance than you thought. Or conversely, if it went down a little bit and you still felt terrible, well, that may tell you the opposite. So pay attention and learn from your experiences. So, in sum, thought I'd never get here, huh? Professional expertise can help you make decisions. The idea of get a little bit of learning so you know what questions to ask. When someone says when a professional hands you a risk tolerance questionnaire, you know what it's for and why. Understand that your situation is unique. Don't let somebody try to cookie cutter you. Everybody is slightly different. Okay, your situations may be similar, and certainly you want somebody who's dealt with something that perhaps you're going through. Right, saving for a house is saving for a house, or saving for college, or saving for retirement. But we all have different. There's lots of factors that need to be manipulated. So make sure that your situation is being set up for you. And then at the end of the day, ultimately, you are the one that's responsible for your investment results. You're responsible to get started early. It's your responsibility to choose an advisor wisely. And if you don't like your advisor, change your advisor. And ultimately, it's up to you to monitor your portfolio and be honest with yourself to help you get to where your goals are. Some great places to start. John Bogle, who was the founder of Vanguard, he's got some great common sense investment strategies. One of the things, trees don't grow to the sky, things like that. That's tells you a lot of basic, real world examples that are easy to understand. And then the Christine Benz provides a little bit more detailed about specific investments, and that will provide you a couple of good forms of references. Of course, the financial planning organization is happy to be of service, and lots of resources on our website. And you can find qualified planners if you want to find an individual. You can break it down by how much they charge and so on. Most will offer a free initial consultation and kind of go through some of the planning areas that we discussed. And of course, before you do invest with somebody, everybody who is licensed by FINRA, the Financial Regulatory Association, we all are available on BrokerCheck. So you can see our history, whether we've been disciplined, and certainly it's worth 5 minutes before you hand over your money to anybody to manage and be your resource. And with that, I thank you, and I'm happy to answer any questions you might have.
Thank you, John. You covered quite a bit of material there. So our first question is, what are the best college savings accounts?
Well, the 529 is your traditional college savings account, and those are very easy. You can set them up yourself. The if you know exactly what school that the student wants to attend, sometimes you can prepay tuition and they will lock in fees. So there's a couple of different ways to do it. Um, but generally for a pure college savings account, now there's also minors accounts, UGMA accounts, and various other accounts, but the 529 generally tends to be the most flexible.
All right. We have another question. What do you suggest for someone who is older, older than 50 years, and hasn't started investing yet? Do you recommend that person go ahead and start investing?
Wow, that yes. Look, even if look, I just had my 60th birthday yesterday, and the way I see it, I just entered the final third of my life. So that means 30 more years. That's a pretty long investment horizon. And so if I need my money to last, if you're 50, you could at least get that. Think about that slide. That $10,000 can turn into $100,000 by the time you're 80. So absolutely, I encourage you to invest, and it's never too late to start.
All right, sir. We have another question. What do you say to people who contend the market is overheated and due for a crash?
Well, you can't win if you don't play, and markets do go up and down. And personally, I have thought the market has been overheated for a year and a half and have been wrong. But I haven't not been invested, and so you need to prepare for that. And if you do honestly have trepidation about the direction of the market, then you dollar cost average, and you know put a little bit in and maintain a cash balance. And if you're concerned, you can still invest in stocks that or in investments, whether they be fixed income or other types of investments that aren't going to be subject to stock markets ups and downs. So whether that's a CD ladder, whether that's real estate or some other alternative investment, there are there's a lot of different ways to invest.
All right. We have a question. What are some good ways to truly measure or test your risk tolerance to help make good allocation decisions?
Well, you first have to get the read on the risk tolerance. And so the risk tolerance will, there are questionnaires that are available. If you go to a lot of large brokerage sites, you can find PDFs online. Virtually every financial planner will have one that they can administer to give you a sense. And generally, they're scored based on your answer on a multiple choice. And then there you will get a number. And another tool that planners have is then they can use that number to match up with a portfolio that mixes a variety of investments. So as I mentioned, bonds tend to be less risky than large stocks, which are less risky than small stocks, and so on. And so Jamie just posted something you can find that on the FPA site. The questions to ask your planner, but then again, that score will match up to your risk tolerance, and then that portfolio within a certain amount will match be one that meets the the amount of risk that you were willing to take, at least starting out.
Let's see. The question is asset allocation best made across all of my money, or should I have separate asset allocations for my 401k versus my non-retirement investments?
Good question. Good question. Generally, it depends on what type of investor you are. So if you're putting money into a 401k regularly and so on, and you want to set it and forget it, a target date fund for at least a percentage of your assets, and you're really investing for the long term there. And depending on how far you are away from retirement, would determine how much risk you can take in that portfolio. If you manage a Robinhood account, or you have a Schwab or Fidelity or whatever, and you like to play around and have stocks, understand that that money is a little different and you treat it a little differently. So if you want to have a play account and then a more serious account, in your play account you're going to have small stocks and more speculative investments, and then in your retirement account you're going to have invest more for the long haul.
When picking a financial planner to help with my investments, what are some of the things I need to think about in selecting the right planner to work for me?
Jamie just posted. There's if you go to if you go to www.letsmakeaplan.org, there's an option on how to choose a planner, and there's 10 questions that you can ask, or that you should ask your planner, and it relates to fees and philosophy, and what their service model is, and things like that, and things that are important to you. Do you want a planner that is going to update your plan or reach out to you every month, or do you just want a one-time shot to get started and then move on? You want someone that does fee only and doesn't manage assets, or do you want someone that does both? Those are the type of questions that you're going to ask, depending on what you feel, what type of relationship you're looking for.
Do we have questions? Yes, we do. What's your opinion on investment apps like Public?
Like which?
The question is, it's about Public, Public.
I'm not familiar with that one. I keep up with my fintech pretty well. There are information apps. There are like Robinhood passes the trading. They're trading. They don't do their own trades, right? So part of the whole issue with Robinhood and some of the other things is they pass them on. So various apps. It depends on what you're looking for, but be wary of the gamification of investing. You still want to do your due diligence and don't get caught up in all the excitement.
All right, John. Looks like we have one more question here. What's the best way to start investing in real estate?
In real estate. Well, do you want to own the hard asset, or do you want to just invest in real estate based assets? So, if you think about the hard asset, which would be obviously, buying a land, a home, or a real estate asset, and what that involves, it's not very liquid, or so on. Or you can buy a real estate investment trust, which is known as a REIT. And what they do is you're investing in a company that invests in real estate assets. And so that's a great way to invest in things like distribution centers, right? So if you see Amazon and the pandemic and all that continuing, be tough to go out and buy a distribution center, but you can invest in a company that does, or self-storage, or apartment buildings, or whatever you want. So that's a way where you can participate in what's happening in the real estate market, even on a sector by sector basis, without locking yourself into a large and generally a liquid asset.
All right, sir. That looks like that's the end of our questions. I want to thank our guest, John Horn. And just for those who are still with us, I want to let you know that Financial Literacy Week is continuing through Saturday. Please join us for the remainder of our financial literacy workshops on the topics of the benefits of opening a bank account, elder care, learning about financial literacy, and Financial Literacy Day on Saturday, April 10th. Although we have one-on-one telephone consultations with certified financial planners scheduled for Saturday, all appointments are currently booked. But we expect that there will be some no-shows, and we encourage you to sign up on the waiting list in the event that appointments become available on Saturday. For more information on our programs this week and to sign up to speak to a financial planner, please visit https://www.lepl.org/financial literacy week. And thank you for coming to our program, and thank you once again to John Horn.
Thank you, Chris.
My pleasure.